Good evening, everyone, and I extend you all a very warm welcome to this eighth webinar series, which is an educational initiative jointly undertaken by PhillipCapital and BSE, with the sole objective of sharing knowledge and market insights for everyone connected to global markets. It's indeed a pleasure to welcome all of you, and thank you so much for taking your time out to present in this webinar. My name is Vishaka, and I'm a part of FX Advisory Desk at Phillip Capital. So we are a Singapore-based company established in 1975. We are one of the Asia's leading financial institutions with a global reach extending into Europe, North America, and various other countries in 15 countries. So we have asset under management worldwide more than 30 billion USD, having 1 million clients worldwide. So at this onset, I would like to thank Mr. Vijay Krishnamurthy and Mr. Kasturi Soundarajan and for sparing their valuable time and for consenting to be a part of this webinar series to share their valuable market insights. Mr. Vijay is head of fixed income at BSE and he will share his part of the PPT. Thank you, sir. Over to you.
Uh, Thank you, Vishaka. Thank you so much for the introduction. Good evening, one and all. And it's indeed a pleasure to be, once again part of this webinar series along with Phillip Capital and the topic which is Forex risk management policy. And so thank you so much. What I'll be really doing today is, maybe sharing a short presentation of the BSE's initiatives on the currency derivatives side, and also giving a brief overview of the markets of where the foreign exchange market is there in India, and what is how is that really evolved from an exchange currency derivatives trading perspective. So that's what I'm going to take you all through, and that's going to be my part. So is everybody able to see the presentation? Yeah.
No, not right now. Can you just
Not
share?
right now. 1 second, I'll just share. Just 1 second. Just 1 second. Just trying to share. Yeah. Yeah, is it visible now?
Yes, yes, sir.
All right. All right. Thank you. Yeah. Thank you so much. So as you know, it's just a very basic. The foreign exchange market today is divided into two. One is the OTC and the exchange traded derivatives, currency derivatives. On the OTC, you have typically banks and corporates, and the products available are spot futures and the options. And on the futures and on the exchange traded, you have the futures and the options, and the three exchanges that are there today are BSE, NSE, and the MSCI. This is some numbers on the OTC forex market with vis-a-vis the exchange traded currency market that we have. Going ahead, this is a very interesting graph that is there. It typically shows you the journey of the exchange traded currency derivatives. The exchange traded derivatives currency derivatives started somewhere in 2008, and the first pair that was launched for the currency futures was the USD INR, which is one of the most popular or the most traded pair. And if you look at it, the kind of journey that it has traversed from 2008 to 2021 today, from a turnover of about 1200 crores in 2008. Today we are roughly at 70,700. So that's been an a very good and a very strong journey that the exchange traded currency derivatives have had. In this entire journey, BSE launched their currency derivatives on in 2013, to be precise, on November 29, 2013. And over a period of time, it has also significantly gained market share, and there are a lot more institutional participants, banks who are participating on the BSE's exchange currency derivatives. We have also introduced a lot of new products, and as early as December, we've introduced our weekly futures and options on the USD INR pair, which is also doing really well. So so, so what we strongly believe is, along with the OTC, the exchange traded derivative currency derivatives have also really picked up, and it's of course it's got its own set of a lot of advantages which is there, and we see this journey only, this graph only peaking and possibly exponentially increasing. So this is basically, I just would like to put up the screen wherein it shows the various contract specifications of the various contracts that we really have. As I said in the previous slide, we have the weekly contracts for the USD INR, and monthly contracts are available for USD INR, Euro INR, GBP INR, and JYP INR, and also the cross currency, which is the Euro USD, GBP USD, and the USD JPY. So these are the contract specs. I'll just leave it, leave this on the screen for maybe about a few seconds so that you can eyeball it, because anyways, this is also available. Uh, Now, what are the typical differences between an OTC as well as the exchange traded currency derivatives? It's largely, the main points are the contract size, the documentation or the underlying, the kind of entry exit that is there, and the currency derivatives as a quick entry and exit, and no hassles of cancellation or rebooking. Contracts can be closed or squared off anytime during the life cycle of a particular contract. So these are certain advantages that the exchange traded currency derivatives carries over the OTC. Again, the market timings are from, you can very clearly see there's a significant kind of an advantage over there. There's a lot of price transparency which happens on the exchange traded on the exchanges. Then you have an inbuilt mark to market mechanism of paying receiving the mark to market differences based on a daily settlement price. Accessibility is easier. The transaction cost vis-a-vis an OTC is much lower, and on the option contract, no documentation and available to all the participants. Whereas on the OTC, you have stringent documentation, a lot of restrictions. So very clearly, there are significant advantages, that one has on the exchange traded currency derivatives as compared to the OTC. Although the OTC gives some kind of inflexibility, but the ETCD really clearly weighs more. The advantages weighs much more than that of an OTC. This is just one example. Maybe I think so. It will be taken up in the second part much more in detail. It just tells what's the kind of an hedging example that an exporter would do in case to cover himself against a currency fluctuation, which where he would buy and he would sell an USD INR and typically buy a put option, and vis-a-vis as compared to an importer who would buy an USD INR and also buy a call option on BSC. And typically the same applies to other currencies also, which could be euro, pound, yen. Coming to very specifically BSE's currency derivatives, as I said, it is launched in the November of 2013, and currently we are clocking an a daily average turnover of close to 26,500 crores in FY 2021, and we have come a long way. We started this journey with about 550 crores in the first year of operations, and from there on we have really picked up. We started as an exchange. We started this after the other exchanges, and however, we have significantly picked up in our volumes as well as in the market share of the currency derivatives. BSE has also launched the USD INR weekly options and the options contract in July of 2018. And it is one of the most cost-effective exchange for the currency derivatives in India. And this is something that we will see in the upcoming slides. These are the various contracts which are available on the BSE's platform, which is your USD INR, Euro INR, GBP, and JYP, and similarly for the cross currency. And as I said, we have the weekly futures and options contract on the USD INR right now. So what are the benefits of trading on BSE's currency? As possibly most of you all or everybody would be aware that BSE is technologically very strong, and it's all the platforms are enabled, with the latest technology. We are also, we boast ourselves to be the fastest currency exchange with a speed of 6 microseconds. Front end co-location, internet trading, everything is available. We have the necessary liquidity onto our platform. We have the clearing corporation, which is our ICCL, in terms of the risk management and settlement. We have very clear and robust risk management systems in place, online margining, and there is no counterparty risk. Significant or wide participation, largely by banks, FPIs, prop traders, corporates, and retail clients are typically, these are the backbone for us onto our platform, who also keep quoting and provide this kind of liquidity into the market. Innovative products and features, that's something that we keep coming up with. And as I had spoken in the last slide, reasonable charges, and we are the most cost effective exchange for currency derivatives in India. The charges as low as rupees 22 per crore. And this is basically a cost comparison on the currency derivative side with the three exchanges. As you can very clearly see, that's it's 22 rupees per crore as against 90, which is an easy saving of more than close to 75.5%. And on the option side, you save as high as 97.5%, because the per crore cost at BSE is rupees 100 as compared to 4,000 on NSE and 2,000 on MSCI. Let's just take an example on the futures. We can see very clearly, for one lot and for a lot of 10,000, the comparison between the two exchanges. And on PSE, for a lot of, for one lot, the total cost is less than a rupee. It's 0.61 paise as compared to 1.80 rupees on NSE. And for a lot of 10,000, it's 68,000 6,832.76 paise as compared to 18,761.84. Now you look at, because you are participants who train in multiples of a few millions. So if you look at that comparison, for a USD INR for 10 billion 10 million, sorry. The typical saving that, or a cost benefit that you do by trading on BSE in a month's time, is 2,38,581 rupees. And the cost benefit that you would have while trading on BSE for 1 year would be more than 28 and a half lakhs. To be precise, 28 lakh 62,979.25. This is basically done on a base of USD 10 million. So if you were to do that, that would be a significant cost saving for you all, for the participants who would be putting doing their trades or participating on BSE for the currency derivatives. This chart clearly shows, the kind of daily average turnover, timeline from November 20 onwards. And we can see that, this chart has only significantly been on upswing in the last financial year as well. And as I had mentioned earlier, currently we have an ADTV of close to 26 and a half 26 and a half thousand crores per on a daily basis. So and this next slide basically gives you a pictorial view of how it's easy for an onboarding for an exchange trading currency derivative. And the process is very simple, whether you're an investor or a corporate, whether you're online or offline. You connect with your member, and he trades on the exchange platform, and the clearing corporation really passes back all the information back to the members, who then gets back to you all. And you need to open an account with an intermediary or a broker, submit the required documents as prescribed by the regulator, and deposit the exchange specified margins, execute trades, and you also get the daily MTM. So it's very convenient. It is, as we have seen in the earlier sites, the clear advantages of exchange traded currency derivatives, and also more on top of it, the kind of advantages that you have for trading on the BSE's platform, and the most important being the cost advantage that we really that we saw in the previous slide. Uh, so we so this is what I had basically today, and we'll be happy to take any questions at the end of the session now. And thank you so much.
Thank you, Mr. Vijay. Now, I would like to invite Mr. Kasturi Soundarajan. He is the Chief Treasury and Investor Relations at Tata Power. Prior to joining Tata Power, he began his career with NTPC, the largest power generating company in the country, and has also worked with various other major private power developers. He's responsible for managing the fundraising activities for Tata Power and its subsidiaries. He is handling the investor and other stakeholder relationships such as lenders and rating agencies. As part of the role as treasurer, he also has the responsibility of framing adoption and oversight on the foreign currency risk management policies and strategies. In a career spanning more than 3 decades, he has significant experience in raising finances for large power projects, both equity as well as debt. Now I would ask Mr. Soundarajan to continue with this PPT. Just a request to all the participants, if they have any questions, they can write to us in the chat box, and once the PPT is over, and then we'll take the questions. Thank you. Over to you, Mr. Kasturi.
Yeah, thanks. Thanks for that introduction, and very good evening to all the participants. And I hope that each one of you is safe, and all your, the loved ones are also safe. And yeah, I think this is a good. I'll just probably try to share my screen, and then hopefully, if you can. Yeah. Are you able to see the screen?
No, sir, we are not able to see the screen right now.
One, I'm just. Is it visible now?
Yes, sir.
Yeah. Okay. Thank you. So I think just to first set the context right, obviously Tata Power, I think probably may not need a kind of an introduction to all of you. We are a power utility. We are one of the oldest power utilities and one of the largest. And one would then think that what is a power utility to do with Forex management? But the fact is that, yeah, while we are a power utility and we do obviously generate and transmit and distribute power in India, and primarily, largely, it is obviously it's all our revenues are in INR. But at the same time, obviously, when we set up power projects, these are power projects which involve a lot of capex, and these many of these capital equipments obviously come from outside of the country, and therefore we have to import, and therefore there is a foreign currency exposure when we do those imports. The second aspect is when we then borrow for putting up of these capacities, and these borrowings, of course, many times we do from Indian banks or Indian market, and therefore they are in rupees. But then also we do borrow from offshore, whether it is ECB loans or it is bonds, offshore dollar bonds, and therefore there could be a foreign exchange exposure there. The third foreign exchange exposure which we have is also when we import our fuel. Many of our power plants also, use coal as obviously as a feedstock, and many of our plants also have to import coal from outside of the country, and particularly like places like Indonesia. And again, therefore, these are obviously to be paid in dollars, and therefore there is again a foreign exchange exposure there. So there are broadly, therefore, three components of the foreign exchange exposure which we have, and therefore we have been managing that. Now, what I would want to share in this presentation, and I do really want to make this, as much as possible interesting to all of you in terms of the learnings which we have had over a period of time in doing this foreign exchange management, and then share that with you, and hopefully you all will gain out of that. And I reiterate that the point which we have in our fundamental foreign exchange management philosophy is that we are obviously a company which has primarily rupee revenue, and therefore we are not in the business of trading in forex and making any kind of revenue or a profit out of that. Essentially, our the philosophy is fundamental about the discipline to protect our capital. So therefore, if you really look at the kind of the theme which we have put out for this presentation, is risk management for us is not just about predicting volatility, but actually it is about discipline for protecting capital. And I do hope that the things which we have done will also help you in doing that. Now, if we come to this slide, which is showing the kind of the current account deficit which India runs, it's basically what we are trying to say here is that India has been importer always, and will probably continue to be that way for quite some time to come. And therefore, there will always be a current account deficit, which will be running. I mean, it's going to be quite some time before probably the situation may see a reversal, which is really a long way off. So given that, it is all likelihood that the rupee is generally going to have a depreciating bias. So that's fundamentally something which I think all of us probably would tend to sort of agree on. Now, if that's the case, well, then it's a simple thing that the USD INR pair would always be seeing a secular trend in terms of that depreciation, and therefore very predictable in that sense. The answer to that is actually no. While it is going to be a depreciating bias for the rupee, but it is not going to be a secular, a predictable trend. It has obviously been over the years pretty much volatile in periods, and that volatility can move both ways. Both, in terms of rupee suddenly depreciating appreciably, and then swinging back once again. And these are the periods of volatility which then becomes really unpredictable, and therefore, from a FX management point of view, becomes the point where you need to really take care and be very sure about the policies and the strategies which you have. And if you really look at this chart, it's just for capturing the depreciation of the rupee versus the forward hedging rates. That has always been sort of a disconnect between the two. At some years, it's been the depreciation far ahead and more than the forward rates. In the other years, it's been the reverse. So therefore, just a predictable depreciation rate, and therefore mirroring that with a forward, is also not something which is probably a good FX philosophy or a strategy. Now coming to the next slide, which is that why does this volatility happen? I mean, if it is, if generally the rupee is going to be on a depreciating bias, is it something which is predictable, and which is, while it is not, and why is this volatility? That obviously, as all of us and who are FX managers understand, is because of the variability in fundamentally the currency flows. And two of the components of the currency flows which have a huge impact, obviously, apart from various other factors, surely, are obviously the FDI and the FPI flows. And again, if this chart, if you really look at it, has been the FDI FPI flows have been obviously been changing from year to year. While obviously all of us understand that the FDI flow is what is actually probably better for the country, because obviously those are flows which are coming to make investments into your business, and therefore when they come, they are coming for a longer term, and therefore they are going to reverse in the short term, even if there are some fundamental business issues. But so therefore FDI is always seen as a better flow, and therefore if the FDIs do come, then it is always good for the economy and good for the currency markets too. But on the other hand, the FPI flows, which are both the FPI flows into the bond markets and the FPI flows into the equity markets, are the ones which are fundamentally more obviously volatile, because they are obviously investors coming in and putting their money on perhaps sometimes views which are on a shorter term and not necessarily on long term. So, and therefore they are the ones which obviously cause many times volatility on the currency, and therefore they are the ones which are more to be watched. Now, apart from the FDI and the FPI, if one has to look at and track some of the recent key, factors which have impacted the currency, this is not an exhaustive list. They're just some of the few factors which we thought was more important ones, which one has to track. Some of them are obviously the actions by the central banks of various countries. And obviously, of all the countries, I think the most important one, obviously, for the US, the INR pair is obviously the Fed Bank of the US, and how the Fed Bank is managing its own balance sheet and therefore the country's US currency. And that is a single most important component, which I think in the last few years has been causing a lot of obviously significant impact on the USD INR pair. And we all understand that there have been crises in the past when the US has expanded its balance sheet, the Fed has expanded its balance sheet, and now again due to the COVID crisis, they did the same. And then when they go back on that, obviously things are going to have a significant impact, and therefore obviously they will impact the currency exchange rates. Similarly, one of the recent factors which has been causing somewhat volatility in the overall the currency, US currency in particular, has been the US-China trade war, which during the Trump era really took on. And then I think it seems that it may continue for a longer while. And therefore, in that sense, it's not just about the trade, the impact or the trade imports and exports, which is impacted, but obviously it impacts every other country in the world, because if a trade volumes go down or change tracks, then obviously it's going to have an impact on all the currencies, and the INR is certainly not insulated from that. So these are, we thought, two global factors which are extremely important to track. On the domestic front, I think there were a couple of things which we thought was important. One was obviously the equity markets, and therefore the valuations on the equity market and the views of the investors putting money into the Indian equity market, and therefore any obviously change in their views is likely to have an impact, like the flows obviously changing direction, both inwards or outwards. And what we see today, obviously, and is obviously the valuations on the equity markets do look a bit stretched. Of course, there are different views on this, but we do think that therefore that's something which is very important to be tracked and to be obviously be cautiously be looked at as a FX management point of view. The other thing is, of course, the RBI's role, and what RBI does also is equally important. And I think the RBI has been intervening in the markets just to, if not to sort of obviously control the USD INR pair, but certainly to sort of reduce the volatility in the exchange rates. And the RBI has been building up a huge, obviously, reserve over the years, and this they have been using effectively to manage these kinds of volatilities in the market. And I think, therefore, their obviously the stance on how they look at and when they want to intervene is absolutely completely critical, and tracking that becomes equally important. Now, then we come to the fact as a FX manager. So how does one look at these things? And we bucketed those two objectives as a principle for an FX manager or the management which we have, which is that on one hand, an FX manager is to look at risk management, and on the other hand, a cost optimization. Now, on the risk management, obviously, the key deliverable for an FX management philosophy would be to protect the worst case, so that the company doesn't have an exposure which is unprotected and does not therefore end up into a situation which is obviously impacting it significantly. And the way the the risk management could be done obviously is through various measures of identifying and defining risk exposures, and then defining trigger actions based on certain thresholds, and of course obviously complying with regulations. On the cost optimization side, what one would look at is obviously when while as a pure risk management, one would probably want to take a view that the best is to probably hedge everything through a forward and therefore completely protect the downside. But that would obviously leave maybe a lot of things that where suppose there is an upside, then how does one actually manage it? And therefore, there could be different, obviously, strategies to mitigate those kinds of possibilities. And there are different, obviously, option use of the options or a stop loss strategy, and obviously putting a strategy around these things is what probably the FX management would look at. Now, therefore, given all this, what would be the risk management framework which should take care of all these fundamental requirements? We had bucketed that into 4 sort of broad categories, which is one is that putting in place a risk management strategy. Then 2, having a structure and an infrastructure in place to sort of implement that strategy. And 3, having a hedging process in place to actually implement those philosophies and the structures. And last, of course, but not the least, is monitoring those. I'm not going to go into each of these in detail because I'm sure that many of you probably do this. And maybe, therefore, even if not, maybe putting a framework in place, I'm sure that many of you would be doing this most certainly. So, as the first leg of this, the framework is of the risk management strategy, where obviously, the objectives of maximizing of profit or minimizing cost, and then quantifying those objectives, and then adopting strategies which could be dynamic hedging or a static hedging, and then taking a view on the whether it is a view-based kind of a management one follows, or one does something which is more of a defined hedging strategy. Now, this is something which one will have to do, and obviously these strategy will have to be approved by the necessary competent, obviously the authorities. And once that is done, then putting together a structure which will have probably the organization required to implement that risk management strategy, and then at a functional level, separating maybe the front office and the back office, and then having monitoring mechanisms for the market data, and then having obviously dealing rooms and the necessary knowledge and the experience to do all this. Then on the hedging itself, obviously, capturing the exposures, defining hedging ratios, or keeping it open by having a dynamic hedge ratios, and then defining the hedging instruments which are used, and then the hedging the decision making process itself in terms of the hedging. While the strategy is already put in place and the structure is there, then who are the people who are actually taking these decisions, and what will be those approval processes, and then what will be the hedge execution itself, are things which are extremely critical and needs to be put in place. And then finally, of course, the risk monitoring itself, which is that once you have a defined philosophy and an hedging process, then monitoring that clearly and seeing whether those strategies and the implementation of those strategies is delivering the results which are obviously the intention. And if not that, if they are not obviously meeting those requirements, then possibly doing some course corrections, revising those strategies or the policies. The other aspect of the risk management framework, of course, is this whole issue on the regulations and the documentations required by the regulator. Obviously, RBI has a lot of regulations in place. There are broadly 3, circulars. One which talks about the risk management and the methods of hedging. RBI has been coming out and then, coming with some changes to this, making it more sort of robust, and also helping and giving some kind of a leeway to organizations now to be more flexible on the kinds of products and also the underlying which can be used for these kinds of the risk management philosophy. Now, the other thing which RBI has also done is also put a very comprehensive guidelines on the derivatives on the instruments which could be used and how they can be incorporated and backed by board resolutions. And then, of course, the whole issue on the RBI giving the guidelines to the banks on the capital and their provisioning requirements, and this whole, the requirements on unhedged currency certificates which are to be provided and to be monitored by the banks to ensure that corporates are stringently being monitored on those and do not go beyond what is required or approved by their respective boards and as per the requirements of RBI's regulations. Now we will come specifically now. This was the broad, the framework, but I'll now come to probably the specific framework which we have in terms of what we do. And the way we are structured in Tata Power in terms of our FX management is that we have a risk management committee, which is a committee which is obviously set up by the board. Now, this committee has directors both from the company as well as the independent directors. And this risk management committee is the one which is interested with the responsibility of putting a risk management policy together, approve that policy, and then ensure that that policy is adhered to. And the committee obviously monitors that on a periodic basis. Now, what we have done is through this committee, after the policy is approved, we have what we have as we call it as the FRMC, which is the Foreign Exchange Risk Management Committee, which comprises of the CFO, the finance controller, and myself as the head of the Treasury. Now, this is a committee which is obviously oversees the implementation of the strategy and the policy approved by the board. And this committee obviously meets much more frequently and to ensure that the hedging is done in accordance and within the boundaries set by the board. The secretary of this committee, of course, is myself as the head of the Treasury. And then we have a Forex team to actually implement those deals. Now, within the company, who are the customers for us meaning thereby that who are the people, who are the teams, who are the businesses for whom we do the hedging? They are primarily for us, the coal import businesses, and we have listed as CGPL. This is one of our projects which imports a lot of coal. And then the whole, the one entity which is Tata Power Solar, which does a lot of import of solar panels and modules from China, and therefore there is a lot of exposure on the import payments which are paid by them. And then we have dividends which flow from our overseas businesses which we have, and also the borrowings which we have taken offshore and the interest rate exposure which we have. So these are broadly the teams which are our customers in terms of for whom we do the hedging. And on the other hand, what are obviously with the counterparties which we have is the banks, and what are the tools which we have to implement and execute these hedging transactions? On the one hand, we have obviously the Bloomberg and the Reuters terminals, which help us in executing those deals by monitoring and seeing the real time, obviously the structure. And I think as the presentation began with the BSC platform, there are those platforms also available now for us to also use for hedging. And then, of course, the banks, which are then we have consultants also, who help us in sort of making up the decision on the hedges. Now, in terms of the objective which we have for hedging in Tata Power, we want to ensure that our estimates of the cash flow in rupee terms are as much as possible are close to the estimates. When I say estimates, obviously when we put up projects or when we are importing equipments, obviously there is an estimate of the cost at which these equipments would be imported, and that estimate usually is in rupee terms, and obviously that estimate will take into account the exchange rate at the time when we are making those placing those orders for the imports, and then projecting it over a period when those imports will materialize. And therefore, those estimates are extremely critical in terms of the business fundamentals. And therefore, our objective for FX management is to ensure that the estimates for these businesses in terms of rupees are as much close as possible to the estimate as possible. And while at the same time, we will want to hedge those with the best possible instrument, also like to see whether there are upsides which can be captured. Now, the policy which we have in Tata Power has the thresholds approved by the board, which is that anything which is less than 1 year will have to be fully hedged. And when we say fully hedged, we mean that it can be a mix of forwards and some other instruments, but with strict maybe stop losses, which are defined by the FRMC. And then the exposures for a 1 to 5 year frame are also fully hedged, but again with a combination of different kinds of instruments which are allowed by the FRMC. While for any exposures beyond 5 years, the policy does not require a hedge to be taken. Now, in the case of the interest rates, wherever there are risk of the dollar exchange interest rates, for anything which is less than a year, 5 year exposure, we do want them to be sort of be covered on a rolling basis, while an exposure of a period of more than 5 years is not required to be hedged. Now, this is the FX management life cycle which we have put, which is basically just in simple terms, map the exposures, capture the exposures in the best possible way. Because if you miss an exposure, because if you have different businesses and different businesses have different exposures, like I said, coal imports are on a continuous basis happening for us. Equipment imports continuously happen from different businesses. And of course, we have this debt servicing happening in different for different entities. Now, therefore, capturing those exposures, mapping those exposures is extremely critical, because one should not be, leaving out any exposure unmapped, because then it is obviously a risky proposition if that's not captured. Now, and then after that, obviously, the hedging strategy, which is obviously, like I mentioned, the whole process of putting that together, and then monitoring the effectiveness of that hedging strategy becomes very critical. And then monitoring it on a periodic basis to ensure that what was the objective of the strategy is being achieved. And if the outcome of the strategy is not what was set out, and then go back to obviously to the committees and the risk management committees, and then take a view and an approval on obviously making those the required changes to make the hedges more effective on that particular strategy. And then, of course, the final thing is do the actual hedging itself and the reporting of those hedging in terms of the financial reporting, in terms of the accounting and the financial statements. So I think, therefore, this whole life cycle is, therefore, the capturing of the exposures, implementing the strategy, but then monitoring its effectiveness, and then finally, reporting the outcome of those through a robust reporting mechanism. Now, that is it from my side. So we are happy if there are any questions to be taken.
Thank you. Thank you, sir. So I would like all the participants, they can write their questions if they have any, so we can take them up.
Yeah, I think I can see some of the questions on the chat box. So maybe the first question here is, what is the regulation for corporates to declare their Forex borrowing? Where is this information available? Yeah, I think every corporate which is borrowing in Forex currency, which is the ECB borrowing guidelines, which are in place, and they have to report it through the required reporting formats, and this is regularly done by all the corporates, and it's a necessary furnishing of information which is to be provided by the the corporate. And the question is, where is this information available? This is, of course, I mean, from a corporate perspective, we obviously report it in our own, obviously, the financial statements, the annual reports clearly show what are our foreign currency borrowings. And therefore, if one is to look at a particular corporate and want to see it, and I think somebody has already replied that it is new notes of the accounts. And the second question was, could the PPTs be shared? And I think yes, I think we will probably, we are happy to share that PPT with the, and yeah, and then the other question was, apart from forwards, zero cost structures are also used with stop loss. Yes, absolutely, yes, that's right. And I think, but what we do is, because zero cost structures obviously also come with some risk elements, and we take a view on the overall worst case scenarios, and therefore our objective is to ensure that we have the minimum possible impact on the exposure which we have, while trying to capture the upsides. And therefore we usually combine our the forwards with range forwards, or sometimes call spreads. Yeah, I think the other next question was, is use of options advisable for FX hedging? Yes, absolutely. But I think, again, I would say that for each of the company, I think the important point is to very clearly define the objectives for the hedging. And that's where I think the whole the philosophy of the risk management from the board and from your risk management committees is important in terms of the boundaries. And therefore, while option is certainly always, options are always, can be used, but whether those options, the worst case scenarios playing on the options, are within the boundaries of the risk, the thresholds which the board and the committees have set. And therefore, if they are, then of course you should go ahead and do, but one should be very careful on ensuring that they are within those risk thresholds. The other question was, I think, on what could be the current hedging strategy where market is so fluctuating, where we should look, whether we should book forwards or options. Yeah, I think here again, it's an interesting question, but I think honestly, again, each entity probably will have a different view. But what we have seen is that in the very short time or short period, when the currencies are extremely volatile, I think it is best probably to do an FX. We are talking about the short-term exposures here, and therefore, because it is very difficult to obviously at the kind of volatility which the currency has, to make take any kind of a view-based, such. And this is, I'm saying, for short-term, obviously exposures. But an exposure which is slightly having a longer, tenor, which is maybe medium or to long tenor, and obviously there I think a combination of a forward with a stop loss strategy could be an option which could be used. The next question was, I think, to what extent are set off of anticipated earnings and expenses done? I'm not too sure what that question means, and that, I mean, obviously if you have anticipated earnings coming in dollars, and you have corresponding expenses in FX, I think if they are predictable and there is a certainty in estimating the anticipated earnings and both expenses, it is certainly possible for you to sort of set it off, and provided it is obviously it has a certain amount of certainty, because otherwise obviously you are taking a risk, and if those cash flows don't go the way it is anticipated. But otherwise, I think if they are predictable, most certainly I think they can be set off. Yeah, I think the next question was that in 1 to 5 years, that you said that a lower proportion of forward. What do you mean by lower proportion when period is 1 to 5 years, where forwards are a nature choice to hedge? No, so what we are trying to say is that you have a choice of hedging it completely with forwards, or using a combination of instruments such as, I'm just taking a few examples of the other instruments that you use, which is that It could be a forward, a range forward, or a call spread. Now, why we are saying that is because, as you saw in one of the slides, and I think I'm sure that many of you would have also experienced that, and we have seen that repeatedly happening. That for when you take forwards, obviously the cost at which you take the forward at any particular point in time may not be obviously be the rate at which actually the currency depreciates, and we have seen it multiple times, and therefore completely doing a forward for a 1 to 5 year period may ultimately end up with you locking into a forward at a price. For instance, if today you're looking at forwards at maybe 5 to 5.5% premium, and then you lock into that today for a 1 to 5 year exposure, only to obviously then see a situation where your actual depreciation is not that much. So therefore, so that to ensure that we are able to sort of capture that upside in the risk management strategy and the philosophy which we have approved, is that in that period there is a scope for us to combine the different kinds of instrument, but we do clearly monitor that very closely, so that in case we have to course correct and convert some of those options, we do that. Now, the next, I think the question was, RBI has come back with exotics post 2008. How do you see the corporates adopting to these structures? Yeah, I think some of the corporates obviously would be maybe be interested in doing this, but we as a philosophy and as a strategy, and our board also doesn't approve exotic instruments for us to use, because very clearly for us the idea is certainly not to sort of make money out of these kinds of hedging options. But we are very clear that what we want to do is be very clear in terms of our estimates and be in line with those estimates, and see that we are able to minimize the cost, but not go overboard. And our board is extremely risk averse in terms of using those exotic products. I think the next question was that, does Indian currency follow the USD, and the Chinese pair, and appreciates and depreciates accordingly? In my view, it does not, because obviously the Chinese currency, like everybody understands, is not something which is completely one can say a free market kind of a currency, and therefore it doesn't, I think, completely follow that. Obviously, the dynamics of the Indian rupee, the Indian flows, and India's economy are pretty much what potentially drives the Indian currency. Of course, there will be impacts of the USD Chinese pair also, but I think it is certainly more Indian pair. The INR USD pair is more driven, I think, by the Indian domestic factors, and of course some of the international factors which we had pointed out. The next question was that hedging is okay with derivatives volumes being good for 1 month. 2 to 12 months are rather illiquid. Do you roll over? Yes, that's absolutely true, because you are right that the long-term derivative market is still not that deep, and therefore, taking a long-term derivative instrument, yes, is sometimes not feasible, and yes, a rollover is what is I think is what we do. Yeah, I think
Yes.
that is
Yes.
all. I think there. Yeah.
Yes, sir. Yes, sir. I think we have covered all the questions.
Yeah.
So we can conclude the session here. So, sir, thank you very much. It was very comprehensive and exhaustive discussion covering all the aspects of the subject, and I'm sure that all the participants would be taking along with them immense amount of knowledge and experience to obtain from your discussion. For any participants, if they have any queries, y'all can contact us. Our coordinates are there on the screen. Thank you so much, sir.
Thank you, and thank you, everyone. Yeah.